So, Tyler, the stock market has had a pretty good year so far in 2023. The S&P's produced a total return of about 17% year to date, which is a pretty solid year, especially a nice welcome change from 2022. But not all stocks are doing well. That's especially true in the real estate sector, which you and I both like to follow. So, what's one stock that you are watching that's kind of beaten down, but you're not that worried about?
Yeah. Well, beaten down is a relative term here. So I'm going to use Terreno Realty. I mean, it's flat over the past year. Um, so take that for what it's worth. It's not exactly, the real like dumpster diving in the real estate sector right now that may be going on elsewhere. But yeah, one of the things, just in the kind of the general sense of like, a rising interest rate environment, cost of debt is more expensive. There's a lot of real estate developers that have probably stretched their balance sheets a little bit too much to do a lot of development as of lately. And when the debt comes due, they're probably going to have to either shed assets or do a lot of other things that are not exactly shareholder friendly. So when in periods of doubt like this, where the market for real estate doesn't look as attractive because of interest rates, because of a myriad of other things happening, I really want to look towards companies with spectacular management and track records of growing shareholder value, even in flat markets. And I think Toreno Realty is one of those companies that does it. They're an industrial real estate company, so a lot of warehouses, distribution centers, things like that. It's been still a strong market relative to a lot of the other real estate markets. And one thing that I like in particular about Terreno over almost anything else, you can talk about strategic positioning and things like that, but one thing that they really want to hammer home, and you can even see it in their investment presentations, is like, we have the best governance of any real estate company out there. The incentives for our management team are based on, growing net asset value per share, growing, per share value of shareholders, which, as much as we kind of want to think that that is everyone's North Star, that isn't necessarily the case. And so in periods of doubt, I really want to trend towards people that I can trust. And I feel like of the real estate companies right now, I feel like Toreno is one that I feel like I can put my money to and know that management's going to do well by me.
Yeah, I'm going to go with another one that's kind of been really impressive in recent years, but I think is just kind of beaten down by interest rate pressures. There's kind of a general rule of thumb that the more steady a real estate company's cash flow is, the more interest rate sensitive it is. In other words, the less that growth has to do with the business and the more steady income has to do with the business, it trades like a bond, for more or less. So Vici Properties is one that I've talked about a few times lately. And I'm actually surprised to find out it's down for the year. It's down 1%, but again, that's compared to a 17% return for the S&P. So as you said, beaten down is kind of a very relative term here. Vici's on the tail end of a multi-year acquisition spree. The company's actually pretty young. It's only been around for 8 or so years. It was spun off from Caesars Entertainment to take some of its real estate into a separate entity. It has since acquired its main rival, MGM Growth Properties. It acquired the Venetian on the Las Vegas Strip. It's actually the largest owner of land on the Las Vegas Strip ever. It owns a lot of the most iconic properties out there. And a lot of people don't realize just how steady the cash flow is from these type of properties. Gaming properties are not normally thought of as being low risk, and for obvious reasons. I mean, I know Caesars has gone bankrupt at least once. Most casino companies struggle to make money, which that's a whole nother conversation. But the real estate behind them is actually a very steady cash flow situation. Most of them are on, say, 50-year leases, for example, with rent increases built right in. There's very little chance that they will not get that rent paid, even if the parent companies go bankrupt. For example, could you imagine the Venetian in Vegas just kind of sitting there empty? The company, even if it went bankrupt, would still want to operate that property. So lease liabilities are very high in the capital stack. It makes it a relatively low risk investment. The company's done a great job of not only growing through acquisition, but making value adding acquisitions. FFO growth has been phenomenal in this company. It's been able to raise its dividend every year since it went public, including one that it just made a dividend increase. It's a pretty high yield stock and very just unfairly treated by the market right now because of interest rates. And that's one that I would buy without hesitation right now. Once again, thank you so much for joining me. Be sure to click subscribe if you don't subscribe to my channel already. And as always, this video is sponsored by The Motley Fool. Be sure to visit www.fool.com/Frankel to receive the top 10 best stocks to buy now.